Good morning, everyone, and welcome to this SAFRI Sustainability webinar on the new UK Sustainability Reporting Standards, or SRS. My name is Alistair Loseby. I'm a director here at SAFRI. I'm the Director of Sustainability and ESG. And our aim this morning is to help demystify these standards and to bring them to life, to help you understand how they're going to affect your business and what steps you should be taking right now. To do that, my colleague E and I will step through the standards and some of their context before moving to a panel of experts with a wealth of other experiences and expertise to help answer all of your questions. On that panel, on the next slide, please, E. Here we go. We'll be joined by, as I mentioned, my colleague, a senior manager in the SAFRI sustainability team, an expert and PhD in environment and sustainability. Also joined by Charlene Scott, who leads the sustainability function in Australia. So, Charlene, I'm very grateful that you're accommodating the time differences for us today. So, thank you for that. Australia are a couple of years ahead of the UK in implementing similar and aligned standards. So I'm really interested and looking forward to hearing your experiences of complying with your standards and also understanding how they're being adopted across the Australian economy. Arthur Hopkinson joins us from Osborne Clarke to demystify the legal applicability of SRS and the links with other international frameworks as well. And Ravi Abuadana joins us from ICAW and formerly of ISSB, the board behind these standards, to help understand the role of the finance professional in particular in preparing these disclosures and the role that assurance can play. First, though, before we get to our panel, I just want to start by sharing some context and the details of SRS. So, how and why have we got to this point in the UK? On the next slide, you'll see, thank you, that we know from the SRS consultation response that the UK government aims for the UK to be a world leader in sustainable finance. And the reason behind that is that because it leads to more efficient and growing markets. Why? Well, because the business case for corporate sustainability is increasingly strong and compelling, and because markets are therefore calling out for this decision useful information. We believe that the business case for sustainability is really compelling, but it does depend on the unique nature of your business. Perhaps you're a B2C premium retailer, for example, in which case many customers say that they choose products based on sustainability, and there's very strong evidence that sustainability leads to greater customer retention too. Perhaps you're in professional services or other sectors that are constrained by a lack of high quality, engaged, and steady talent, with employees increasingly looking for companies who align with their values, and evidence showing that the more employees engage with sustainability work, the more productive and engaged they become. Perhaps you're private equity backed, or you're seeking investment, or you're considering listing over the coming years, and the greater levels of disclosures that come with that, because investors care and they monitor ESG performance. For them, it's about de-risking investments, it's about seeking new markets and seeking new growth opportunities as well. So whether it's about talent or customers, investors or efficiencies, cost saving or reputation protection or accessing new markets, there is considerable evidence that high sustainability performance correlates with greater enterprise value, greater profit, and greater revenue. And that's why the UK government is seeking to become a world leader in sustainable finance and why they've adopted these new sustainability standards, because it's good for business and it's good for the economy. But why these standards in particular? On the next slide, just wanted to say that we'll shortly outline the standards, but it's worth saying that they've been adopted from an international standard developed by the ISSB, or the International Sustainability Standards Board. And it's worth saying that we're not alone in the UK. To date, around 36 jurisdictions globally are adopting or integrating the ISSB standards into their own regulation, covering some 40% of global market capitalization and roughly 60% of global GDP. And without ISSB, then companies and investors are faced with many, many standards that overlap and are confusing, some 600 in fact. And so that's really the role and where ISSB comes in. As the government's own guidance puts it, the ISSB's overriding aim is to provide standards that deliver comparable and decision useful information for investors. The disclosures required by their standards are intended to help investors to compare information between companies, supporting the efficient allocation of capital and ultimately the smooth running of capital markets. So that's, I suppose, why the UK government has adopted these standards and some of the context behind them. It's worth saying as well, just on the next slide, that it's not just the regulatory and legal driver that's going to be shaping and driving the adoption of these standards. But there are lots of other stakeholder groups who will be looking for the information to be found in these disclosures. I've already mentioned private equity and investors who are often the key audience for these disclosures, aiming to de-risk their investments, ensure long-term growth, and grow into new markets. There's also B2B firms who are looking for information across their supply chain to understand their exposure to sustainability risks, understand their scope 3 emissions, and assure their own compliance. Equally, regulators are increasingly seeking confidence in the broader performance and robustness of firms or indeed entire sectors over the long term. And then employees, current and future, are increasingly looking to see that a business takes sustainability seriously and it's not just performative. And we know that talent, as we said earlier, is attracted by purposeful brands and employees are more productive in sustainable businesses. And then there are many NGOs or charities out there, third sector organizations, who also will be seeking to drive change across a range of issues and using these disclosures to identify the businesses with the greatest risks and therefore the greater exposure to their causes. And there are many, many others that will depend on your unique business and sector. But there's a clear trend towards corporate sustainability, creating a likelihood that these pressures, even if they're not there at the moment for your business, will grow over the coming years, creating more pressure, more opportunities for businesses to use SRS to benefit and meet the needs of your various stakeholder groups. So that's the business case for these standards, some of the context behind them, and also a view of why this matters for many businesses, even if you're not immediately compelled to do so through regulation. But now that we've covered some of the why, I'm going to hand over to my colleague in the Safri Sustainability team, E, to cover, I suppose, what these standards are in a little bit more detail. E, over to you.
Thank you, Alistair. So hi, everyone. I'll be providing a high-level overview of what the UK SRS actually look like. So thanks for setting up the business case for the standards. Now the what part is really crucial for the preparers and to set expectations on what to expect in terms of disclosures that's going to be presented in the financial statement as part of the financial statements. Starting with the structure of the UK SRS. So overall, as Alistair has mentioned, the ISSB standard has been adopted across the world, and UK is following the same suit as others who are mirroring the structure of ISSB S1 and S2. So we kept the mentioning of S1 and S2 in UK SRS. S1 refers to the wider consideration of sustainability information in general, whereas S2 is related to climate-related specific information. So under S1, there's also a quite clear narratives about what's the overall objectives of the standard. So the standard is actually catering for the primary users of general purpose financial statement. That being said, they really refer to the investors, lenders, and other creditors who would use the information disclosed in financial reports to make their decisions about allocating resources to the reporting entity. So S1 also sets up some other conceptual frameworks or conceptual concepts that underpins both S1 and S2. For example, the primary user being explained just now. And then there's also the reference to material information. So what's in scope for disclosure is really referring to the material information about sustainability or climate-related risks and opportunities. By materiality here, we are referring to the same concept or similar concept when it compares to the financial accounting standard. Material information refers to information if they are omitted, misstated, or obscured. They can reasonably be expected to affect those primary users when they make their business decisions. So S1, as I mentioned, is covering a wider range of sustainability topics, whereas S2 looks at climate-specific ones. That is really similar to the recommendations suggested by the TCFD, the Task Force on Climate-Related Financial Disclosure, which some of you might already have been working on those disclosures over the past few years in the UK, as it's mandatory for larger and listed organizations. So S1 and S2, when it comes to material information, there's also the room for disclosure on other sustainability-related information that can probably tailor for wider type of stakeholders, but then those information should not obscure the main message that's covered by what the content is required under the UK SRS. So if you are disclosing a wider range of information on sustainability, such as if you have other obligations to cover GRI or other reporting frameworks, it should be clearly identifiable that your content under SRS should be there, and then it shouldn't be obscured. As I said, the neutrality of the information is quite crucial. And on this slide, you can see the core content for the standard as required. If you're already reporting against TCFD, you might be familiar with the 4 pillars. So starting from governance pillar, where the users of the financial statement or wider sustainability statement are looking at the overall governance setup about how do your board and your management team really how often do they monitor the progress against the progress against sustainability or climate-related risks and opportunities. These disclosures are covering the detailed processes, internal controls, and other procedures that can be put in place to ensure the overall governance structure and the overall infrastructure about governing the sustainability-related risk and opportunity management is solid. And then the second pillar is on strategy. So usually this pillar covers a lot wider disclosure in terms of the quantity of the information covered by the overall disclosure compared to other 3 pillars. So on this pillar, we're looking at a forward-looking approach. So that's looking at a sustainability or climate-related information covering the short, medium, and long-term time horizon-wise. And the definition of the 3 time horizons can probably differ based on individual companies. So if you are defining your own definition for your short, medium, and long term, it's ideal to disclose the rationale and justifications behind those definitions. And the impact of sustainability or climate-related risks and opportunities should really be disclosed on your business model, your value chain, your strategic and also operational decisions, as well as financial and impact that can be seen, both on the current reporting year as well as anticipated impact for the future years. And one key element for a strategy pillar is to really help primary users of the general purpose financial reports to understand what is your business resilience against those risks and opportunities. So risks and opportunities over the longer, medium, and also short term should really be assessed against your business capability to adapt to any uprising uncertainties that can be imposed by those elements. And then S2 in particular have specified the use of climate-related scenario analysis, which is really to look at how does your business remain resilient against different warming potentials over the future time. And scenario analysis is a requirement as of now based on our current existing TCFD reporting requirement. However, there's also increasing expectations to incorporate quantitative information as compared to only qualitative kind of information out there. And then we are moving on to the third pillar on risk management. So this pillar is really helping the primary users of financial statement to understand what is your processes in place to identify, assess, and also manage your risks and opportunities across sustainability and climate-related areas. So this pillar is actually going a bit further than current requirement compared to the TCFD aligned requirement, which is looking at what are the input, what are the parameters that you use to assess the risks, and also that can cover what are the sources of information that you have used. Is scenario analysis part of the assessment? What are the magnitude or likelihood that you have used to assess the risks and opportunities? And another aspect of risk management is really to look at if your climate or sustainability related risk management framework are integrated into the overall business risk framework or not. And if not, what are your steps in place to potentially integrate the processes all together? And finally, metrics and targets are looking at how does your business measure your performance against potential targets and also against potential risk management and also opportunity management areas. So metrics in this case can potentially be an industry-specific metrics that can tailor for different industries. And if you refer to metrics that are taken from other industry-specific standards, then those standards should be specified in your disclosure. And accompanying the metrics are targets. So these are looking at how does your sustainability or climate-related target are set. They should be SMART, that being specific, measurable, achievable, relevant, and also time-bound. Any targets should really have a baseline year or baseline time point to refer to, as well as the end goal or end deadline for the target. So overall, that's the 4-pillar structure setup for both S1 and S2. And if you're already reporting against TCFD, then this would be really good for you to really probably align to the S2 if you add a few more nuances in your disclosure detail. And compared to the ISSB standards, there are a few differences that have been highlighted in the finalized UK SRS. So in terms of the timing, UK SRS is really looking at connecting sustainability information with the financial information as disclosed in the annual reports. So we are looking at publishing the sustainability related disclosure at the same time as the financial disclosure. Whereas under ISSB standards, they allow, in the first year of reporting, they allow a delayed report for sustainability information. In terms of the effective date, UK SRS have not really referred to any effective date. That being said, it's really to avoid confusion if future regulations got introduced, and then those effective dates for those future regulations should be more clear. So if you are voluntarily want to adopt UK SRS, then you can start probably as of today. Whereas ISSB standards has been effective since the 1st of January 2024. And as we all know, industries in different sectors are facing different issues. So the standards published by the Sustainability Accounting Standard Board, also known as the SASB standard, has been required by the ISSB to for companies to refer to in terms of disclosing sector-specific information. Whereas under UK SRS, we are taking a more flexible role in here. So SASB standard in this case is referred to as an optional choice, whereas companies can choose other industry-based standards to report against. And in terms of the transition reliefs, there are two in particular in this case. First of all is climate first approach. So ISSB standards allows companies to report climate-only disclosure for 1 year, whereas under UK SRS, if you adopt voluntarily to report against this standard, then you can probably take climate-only approach until if you are subject to future regulations, if the regulation says otherwise. And same thing with Scope 3 disclosure as well. So that's under the S2 considerations on climate, especially on the metrics pillar. So here you can probably voluntarily adapt to report Scope 1 and Scope 2 only when you voluntarily report against SRS until for the UK regulations states otherwise. And overall, right now, UK SRS is undergoing a few different considerations, especially when you consider the listed companies. So the Financial Conduct Authority, FCA, is currently running a consultation on mandating the UK SRS for listed companies. That is looking at replacing the existing TCFD aligned requirement, whereas ISSB standards, they are voluntary and their adoption really depends on each individual jurisdictions across the world in different regions. And for non-listed companies, we are expecting the UK government to roll out further consultation on probably through the changes in Companies Act in terms of how do you require probably larger companies in the UK to adopt UK SRS going forward. So that's a quick high-level overview about the standard itself. And I will pass the stage back to Alistair and invite other panelists on stage to have a quick discussion about this topic.
Brilliant. Thank you very much, E. That was a really useful run through of the standards. So yeah, moving on to the panel. After the panelists, please do come on screen and have a bit of a conversation with us. Equally, for those attendees and audience listening and watching us today, there should be a Q&A button, sort of chat function at the bottom of your Zoom screen. Please do put any questions that you have in there. I'm really keen that we build this around your needs. And so anything you would like us to ask, please do let us know and we'll put it through to our expert panel. Also, we're going to be joined by Ravi shortly from ICAW, but kind of having to hold our breath for that a little bit. But in the meantime, Arthur, might start with you, please. So he's just kind of shared a little bit about the consultations that are open at the moment with the FCA, but I was wondering if there's anything else you could share in terms of, from a legal perspective, the sort of current and expected applicability. How is this going to be mandated out to businesses, and how are you expecting that to drive adoption for different businesses across the country?
Yeah, of course. And thank you very much, Alistair and Nii. That was a really, really good overview of where we are at the moment. Like I say, when it comes to sustainability reporting for your business from a compliance perspective, you've obviously got the standards, but the key point from a compliance perspective is the legal trigger. And whilst the driving force for adoption isn't always regulation, those regulations, when they do come in, will require you to report, so it's worth being aware of them, even if you're doing it anyway. So in terms of the applicability of the new UK SRS, obviously, as he said, we've got the FCA consultation coming in. That's going to apply to quite a defined category of premium listed companies to begin with. And if you do think you fall within that, then the consultation's running until, I think it's 20th of March. So there's still an opportunity to contribute if you're interested. Fundamentally, what that means for listed companies is they're moving from a kind of comply or explain framework in line with the TCFD recommendations into more of a mandatory framework of actually requiring climate-related financial disclosures with a comply or explain element for wider sustainability disclosures under the UK SRS 1 and scope 3 emissions. So it's going to be much more of a harder stance in terms of requiring those companies to report on climate-related disclosures in line with the SRS. On private companies, as he said, there is a consultation which is expected. The UK government has confirmed that it is looking to create a level playing field across listed businesses and non-listed businesses. So private companies, particularly what they call economically significant companies. So I think we're likely to see private companies that have TCFD reporting obligations also to be included in scope. And as a bit of a context here, what the UK government is doing is it's got this modernising corporate reporting programme that's currently running. And so we're expected to see a consultation, particularly on how the UK government might introduce changes into the Companies Act later this year to actually create that level playing field and require private companies to report on that basis. I think my general view is that having seen how the TCFD requirements were rolled out on a mandatory basis, what we're likely to see is listing rules change first and listed companies become obligated, moving across through into pension schemes, and then finally the largest private companies under the Companies Act. As I say, there is a lot of pressure, not just from government, but actually from owners of listed businesses saying, hang on, we need to create a level playing field with listed and unlisted businesses. So actually there is a need to drive regulation to require private companies to be included here. And then I think just the final point so I was going to make is that in terms of early adoption here by a private company who might not yet be obligated on a mandatory basis, but you're already doing your TCFD reporting and are required to do that, there's no harm in adopting this early and to take a bit more of a proactive approach, because the government's come back and said, look, exactly as he said, if you are already submitting a report under Section 414 CB of the Companies Act, so introducing climate-related financial disclosures into your reporting, you're required to do that. Actually, just complying with SRS 2 at the moment and reporting on that basis will align you with those requirements. So you'll meet your statutory obligations just by early adoption of the UK SRS 2.
Great. Thank you. That's a really useful sort of way to kind of set that up, I suppose. Something that we've spoken a bit before about, Arthur, is whether, to what extent this is going to be driven by the law or the market. is there anything you wanted to kind of share on that, just to help people kind of get their heads around it, even if they're not necessarily obligated to do this from a management perspective? Now there will be other drivers.
Yeah, absolutely. I mean, I think from our perspective, when we advise clients, certainly in the pass on risk, and we look at the kind of, particularly if you work in sustainability function within a business and you're looking at your kind of broad spectrum of sustainability risks for everything from sustainability reporting to greenwashing through to product compliance, this probably comes down the lower end of the spectrum in terms of regulatory and legal drivers. The reason the laws are introduced in this space is to make sure that there is a consistent approach taken by business to ensure that some of these standards are committed to and complied. It's really about setting the parameters. But really what we seem to see is there is a greater need to comply with this on a voluntary basis because of the direction the market is moving, because of your supply chain demands and what your suppliers are asking you for. Additionally, if you have parent companies who are subject to more onerous requirements in other jurisdictions, then this is something you're likely to see fallout on as a UK business, because you're suddenly required to bring your disclosure and transparency up to the same standard as those parent businesses.
Great. Thank you very much. And Charlene, in Australia, I appreciate Australia's maybe a little bit ahead of the UK in sort of adopting of the ISSB standards. Could you maybe just share what that adoption looks like at the moment? And then would you agree with Arthur's view as well, that sort of businesses are starting to have to think about reporting against these standards voluntarily even before the legal mandates come in?
Yes, no, absolutely, Alistair. So I think, like, from Australia's perspective, like the ASRS have come into play from 1 January 2025. Australia has adopted a phased-in approach. So rather than a one-size-fits-all, it's actually gone with a staggered approach based on effectively turnover, full-time equivalent employees, and asset value. So subject to where you fit as a corporation in Australia, if you're committed to general purpose financial statements, then you are required to either fit as a Group 1, which is the initial adoption from 1 January 2025 onwards. So right now we're starting to see the beginning of those sustainability reports starting to be released. So there's been 4 released so far within Australia under the new mandatory accounting standard. We are now starting to see from 1 July 2026 the second phased-in adoption for the Group 2s, which is effectively the Australian 200 million plus size entities. And then the Group 3s, which are the smaller ones, greater than 20 million, comes into effect from 1st July 2027. In relation to, I think, the voluntary component, we are very much seeing, because of the phased-in approach, it's not just a phased-in of turnover of companies, it's actually also a phased-in approach of scope. So in Australia, we've got Scope 1 and Scope 2 being the first 2 mandatory required disclosures to be committed. It's only requiring limited assurance from an audit perspective. The Scope 3 isn't yet required, and it has got a year grace period in regards to that. I think that the biggest challenge I think that's going to be seen around the Scope 3 is the voluntary component where you fit within the supply chain. The rules do comply with corporations. They are the ones that are required to disclose. The impact I think we're going to start seeing, and I've already started having conversations in that space, is where a Group 1 client is now starting to ask questions of its contractors within its supply chain, saying, what are you doing? You need to start considering how you're working towards this standard, even though it doesn't apply. So we're starting to see that, therefore, there will be this voluntary component that will start to be occurring. And I think it's going to be driving, much smaller entities that definitely do not fit the requirements to mandatory comply, but will be required to comply because of the fact they fit within a value chain.
Brilliant. Thank you. That's really, really useful. And Ravi, I think you've joined us. Good morning. Thank you very much for joining us as well. Really appreciate it. And welcome to the panel. Whilst we're on the subject of the sort of international applicability, Arthur, I might kind of come to you for another kind of quick question. Just any reflections on how the SRS aligns among sort of kind of considerations of the international framework, especially for UK companies that are operating in different jurisdictions or have parent companies, whether it's EU or other ISSB aligned countries?
Yeah, it's a really good question. It's sort of quite a significant challenge. We're saying a lot with clients, which is, yeah, how as a UK business or an EU based business, you are ensuring that your mandatory obligations that you roll out can be consistently applied across multiple jurisdictions. And I think the slight challenges we are faced with, whilst there is a lot of momentum around ISSB, aligned disclosures in terms of the IFRS and the UK SRS, and that kind of financial materiality lens that companies are required to report through. So looking at how sustainability topics impact the bottom line of a business, there is still scope across the world for countries to take a more ambitious approach. So obviously the prime example of that is the EU with the CSRD, so the Corporate Sustainability Reporting Directive, which I'm sure many on the line will be grappling with at the moment, despite its dilution, and the more ambitious standards under that, which actually look towards more impact materiality and looking at how actually the company impacts sustainability topics. So harmonizing how you approach this is really quite a significant challenge. And actually, I think what we're seeing more and more is that if a business is required to report under the CSRD or some of the reporting rules in China or Switzerland, which do have that more ambitious approach, then actually they're taking a more of a gold-plated voluntary approach across their group to say, well, we've got to do it in one jurisdiction, so we're going to do it across the board here because it just makes the most sense. There are obviously alternative approaches, but that's one we're seeing at the moment. And then in terms of where you are just reporting against a similar kind of profit-driven reporting standard, so in line with the UK SRS or the Australian reporting rules, it is really important to remember that although the reporting will be very similar, there will always be national requirements and expectations. So particularly from a regulator, which might be different in Australia, it might be different in the UK. And I think that has already come through on the TCFD, where we've been helping US clients who are reporting under the American California reporting rules, trying to adapt the same disclosures into the UK TCFD reporting requirements. And actually, the UK does ask for more. We do expect more in terms of the explanation around TCFD reporting. And that's reflected in various regulatory stances that have been published. So the Financial Reporting Council has provided a kind of review and update and setting out expectations, what it requires from disclosures. So accounting for national tailored requirements is an important factor when you are trying to just harmonize a global approach to reporting.
Yeah, that's really interesting. Thank you. There's a few businesses that we're speaking to at the moment that are sort of really trying to grapple with this and understand what their applicability is in the EU, for example, or other jurisdictions. So that's really helpful. Thank you. So we spent a fair bit of time this morning thinking about, I suppose, what these standards are, why they're coming in, what the context is. I wanted to spend the next sort of 15 minutes or so thinking about how do companies then actually get to grips with this, and how do they start to move towards being able to comply? And Ravi, I might start with you, please, on this. So I appreciate we'll have a lot of finance professionals and finance teams on the call with us today. So from an ICAW perspective, what do you expect the role of the finance teams to be in meeting the disclosure of these standards? And is it right that I suppose it often sits with the finance teams in the first instance?
Yeah, thanks ever so much, and hello everyone. Great question, and finance teams do most certainly play a critical role here. And if you look at the actual substance, the actual DNA of the ISSB standards, or in the UK SRS, I think what's already been alluded is the financial materiality component to this. The ISSB, the standards, IFRS S1 and IFRS S2 sit within the IFRS Foundation, which also creates IFRS accounting standards. And there is an explicit link to your sustainability disclosures, back to your financial statements. And as Arthur had mentioned, it really goes back to the resilience of your entity, the resilience of your entity from sustainability matters such as climate, biodiversity risks, water risks, human related risks, but also opportunities as well. So it really is requesting finance departments to open up the breadth of information which they need to collect, to look at the resilience of the entity from these particular matters. And over in the UK, you can already see the ramifications of climate on the resilience of entities. For example, floods. Entities have been affected by recent floods, and it's really asking financial individuals to review assets and review the useful economic life of these assets, bearing in mind the frequency of flood situations. So it and then that goes back to how could this be reflected on your financial statements? Are there particular risks? Are there particular impairments which are required? But also on the upside, are there particular strategies which you can put in place to mitigate these risks? Are there access to capital to reduce some of these risks and turn it into perhaps an opportunity? So the DNA of what's being requested by UK SRS is very much linked to your financial statements. It's requesting information from the same reporting entity. It's requesting entity to consider information in the same timelines as your financial statements. So there is a real opportunity for finance professionals to play a leading role in all of this.
That's a great way to summarize. There's a real opportunity for them to play a role in this. I imagine it's quite a shift for a lot of finance teams to start to really get to grips with this. But you say it's a great opportunity as well. And Charlene, from your perspective with the clients that you're working with, what you've seen with your own business as well, I suppose, are there any tips that you'd share? So as businesses are starting to kind of get to grips with ISSB, what can we learn in terms of the resources, the time it takes to comply, sort of common challenges? What are you seeing in the market at the moment?
So I think I'm seeing a few things. I'm seeing that I completely agree with Ravi that the disclosures are finance team based. I think the finance team has got a fantastic part to play in this process. I think the biggest observation I've seen is that it's actually really important for finance teams to expand who gets involved with these disclosures and the discussions. I think it's broader than just the finance team. I think the finance team's there as a collation and an analysis and just, breaking through some of the detail. But I think some of the qualitative information is actually coming from the different divisions within companies. It's coming from, managers of sites. And I think you're getting a lot more qualitative information that actually helps to provide, I think, more context to some of the numbers, because, you can always look at a number and get a sense of what it might look like. But I think it's that story behind it. So I've actually seen with a few clients I've been talking to, they're actually reaching out within the organization, which is fantastic. Like, I think that is the number one tip, I think, is to actually have the conversations amongst the organizations. I don't think it's just a finance team responsibility. Like, I think you actually need to engage with different departments within organizations to help collate information as well. You're not necessarily in a finance team going to have all the nuts and bolts that you need for the respective scopes, or the relationships, like when you start getting into scope 3 and needing value chain considerations. It could sit with different departments in that regard. So I think that that's been probably one of the bigger ticket items that I've started to see. I've even seen organizations actually already start to consider having a sustainability committee internally of different key stakeholders within the organization, whether it's the kind of board members that they may well have some kind of sustainability team, mixing with the finance team, mixing with like the engineering kind of development teams, and actually trying to pull together all the resources needed to try and help and make it feel less onerous, I think, on the finance team. Because one of the biggest challenges that I think a lot of finance teams are facing is that they feel like it's all on them. And I feel like there's actually opportunity to share some of that beyond just them, and actually help engage and create more conversations.
And if I may, and just building upon what Charlene has mentioned, there is an absolute need to collaborate. Um, I was once a preparer, and I am a chartered accountant by trade. What we did was very much akin to what Charlene had just mentioned, creating that sort of task force, spreading the requests for information across different departments. Some of you may be working within a small, medium-sized enterprise, and in this case, it's not akin for an accountant to rely upon experts. From a financial reporting perspective, we already do that. And the same principles would be required from a sustainability endeavor. And Charlene really articulated this very well with regards to how can you go off and collate greenhouse gas information from a scope 1, 2, and 3 perspective. This perhaps is not necessarily the bread and butter of an accountant or finance department, but you can most certainly answer questions from within the four walls of your organization, in particular those entrusted with procurement, and ask them whether they're in a position to start collecting this, or have they been collecting this, and if not, it's asking broader questions on appropriately resourcing this, noting that for those small, medium-sized enterprises, whilst you may not be in the purview of regulation, there possibly will be a value chain ask, noting that some of your customers would be listed entities who would be requiring some of the information from their value chain, i.e. SMEs. So it is a bit of a discovery exercise in the first couple of years, but from my experience, it's a really exciting avenue to explore, and it's an avenue to look beyond the compliance and look at it as a competitive edge component, which is what I saw when I was a preparer, and look at this as a way of getting a wider slice of revenue from your customers, because you're really on top of this, or getting attractive rates from lenders. There are so many opportunities in taking this and taking it beyond a normal compliance aspect.
That's a great call to action as well. Johnny, go on. Looks like you're about to come in.
Yes, I was just going to further to Ravi's comment, just in relation to the financing, but we in Australia are starting to see loans with direct KPIs linked to climate impacts, linked to biodiversity impacts. So we have actually started to see in the last, even prior to the release of this standard, there's actually been companies that have secured favourable interest rates because of what they've committed to do, and that was just voluntarily. So it's definitely something that I think is, making them very much a favoured choice when you are considering who you would be engaging with.
Sorry, Alistair. Just from a UK perspective, I was on a call with the UK FCA, and in preparation for UK SRS, and really building upon what Charlene had articulated from an Australian perspective, they're looking to create some sort of mechanisms within the UK market to do what Charlene had just mentioned. Because if we take a step up, there are genuine risks to capital markets. The whole intention behind the standards was to provide the capital markets with robust information on what those risks and opportunities look like, and to facilitate that, you need financial products to plug that gap. So from a UK market perspective, I think that train has already left the station, and some clarity should be provided on what those products could look like.
That's really good to know. Thank you. And look forward to seeing what that looks like. And please do keep all questions coming in. I was going to ask sort of a couple more before we wrap up. And kind of heard there the first couple of years in terms of like how long it takes companies to really get to grips with this. Charlene, is that sort of what you're seeing as well? That I appreciate you got a bit of a phased approach in Australia as well, but it might take. It's not something that companies comply with overnight. Like they need to do a bit of preparation and it takes a bit of time to really get to grips with it. Is that fair?
Yes, that's a very fair comment, Alistair. I think predominantly companies are viewing, based on conversations I've been having, that they want to be proactively engaging in this process. Very few I've spoken to want to retrospectively, when it gets to the end of a financial year for the first year of compliance, have to go back and try and kind of reinvent all this information. Most of them are very keen to actually be having in place and be ready to go on commencement date, whenever that might apply for them. And they're viewing it as a way of actually being able to make sure that come when reporting is required, it's not going to be an onerous task on them as well. So that's the other part. In fact, the previous comments, I think that time constraint as to how long it's going to take is very unknown. This is a new piece of legislation. We're coming to terms with it as accountants. Auditors are coming to terms with it about what it means from an assurance perspective. We are fortunate in Australia that we have got phased in assurance. So, arguably in the first 2 years, it's only limited. So therefore, there's not a huge amount of kind of, checking required. But that doesn't mean to say that you can just kind of rest on that in the first year. It's a grace period, which then allows you to build on that as you progress, getting ready for reasonable assurance. And I think, doing that baseline assessment and actually getting a sense of kind of where organisations are at seems to be the favourite approach.
Brilliant, thank you. And that's really useful for us, I think, is that as we're getting to grips with sort of the timelines for the UK to sort of learn from other jurisdictions and figure out how it plays back here. So thank you. And it's interesting you mentioned the assurance piece so much as well. Ravi, from your perspective, is that something that we're expecting to? Is that the direction of travel in the UK, I suppose, towards some sort of limited or reasonable assurance around these standards?
Yes. For the foreseeable future, but assurance is something which needs maturity within the actual market itself. And you need companies to be in a position to be comfortable with the information which they are disclosing. So it's incredibly important for regulators to understand the feasibility of reasonable assurance on entities, and to support the market on this journey. And if we take a step up, assurance of information is critical, because one, you can have standards which elicit material information to the markets, but you need the trust in the information to allow investors and other stakeholders to go off and make decisions with that. So from an ecosystem perspective, that's where we need to get to, but you need to take entities on that journey. And what we're seeing from standard setters and jurisdictions around the world who are embedding this within legal requirements for entities to disclose against is gosh, my computer's about to die. Is for them to make sure that they have that level of awareness on sorry, my computer's about to die, so I'm just gonna try finish my comment, and then I'll sort out the technological issues with my laptop. But the critical thing here is, whilst regulators figure out what that journey looks like, entities should really be looking at how they can put in place internal controls and processes to facilitate meaningful assurance from from third parties. So that would be my recommendation to entities as they build out their processes, controls, and mechanisms to facilitate meaningful disclosures to the capital markets or customers if there isn't a necessary legal requirement to disclose.
Brilliant. Thank you, Arthur.
Yeah, I was just going to piggyback off that and just say that, like I say, assurance is such an important tool in giving confidence to the disclosures being put out in the market. And I think this is a nice point that sort of chimes with everything that's been said so far, that there is also a role in the absence of an insurance requirement for legal to help set the parameters of what should or should not be put out in the market. Because like I say, the regulatory push here isn't so obvious, but what is potentially from another direction, which is scrutiny from NGOs, scrutiny from members of the public, interest groups, as well as regulators in terms of more on the greenwashing side, so misleading statements and that side of things. So making sure that these reporting, the disclosures are being used as a value add for the business to really enhance the business competitive edge, but within set parameters which avoid overstepping and making sure that the information going out is of substance and doesn't create a potential business risk, legal or otherwise.
Brilliant. Thank you very much. That's a really nice way to bring it all together, I think. That's great. Thank you so much. And then, so I think as we start to wrap up, we've got sort of one more slide just to talk through kind of next steps. And then we'll try and give you a couple minutes before your inevitable 10 o'clock meeting as well. But first of all, thank you so much for joining us. We've got a great number of participants on the call today. Really do appreciate your time, and also thank you so much to our really fantastic panel as well. Charlene, thank you for joining us. Charlene from Next Australia, Arthur, Osborne Clark, Ravi from ICW, and of course my colleague E here at the Safri Sustainability team. Thank you again so much for your insights and your time this morning. In terms of next steps, what is it that we're doing here, and how can we help you from a Safri perspective? Well, first of all, after this session, we will make sure that we share the slides and also the recording with everyone on this recording today, everyone in the audience today. And then we're looking to continue a stage of engagement around this to help you to get into the detail, understand what are the sort of practical and next steps that need to be taken. So we are planning more online and our first in-person events on this as well in different regions and sectors across the country. So if that would be of use to you, please do let us know which areas, which sectors, where there's the most interest, and we'll absolutely respond to that. We continue to do more deeper research on these reports and the rollout of them, producing insights reports. We're also producing a new quarterly sort of boardroom briefing to give you the tools and examples that you need to act as a business. We're also here to help, and we specialize in an approach that really focuses on the unique case of your business. So who are your key stakeholders? What is it that they're actually most interested in? And therefore delivering SRS disclosures that are, I suppose, they maximize value and decision useful information and impact rather than being sort of cumbersome and burdensome. So from gap analysis to preparation to assurance, we're here to help you across the full spectrum of SRS disclosures. And then finally, if we wrap up, before we do send the slides out and the recording out, I suppose our one recommendation or one sort of key takeaway from you for your business is to maybe have a bit of a reflect on today and start to identify who's going to be asking your businesses for this information and when, whether that is because you'll be in scope for mandatory compliance over the next year, we'll see under the SCA consultation. Maybe it's because you're backed by private equity and you know that they're going to be looking for these disclosures, or maybe you've got major clients who are in scope and you're expecting to come to their supply chain. And then from there, work backwards. So how ready is your current sustainability information against these standards? Where are the gaps? And how long will it take you to code them? And anything we could do to help, of course, please do get in touch. But otherwise, thank you so much for everyone joining this morning. I hope you found it useful, and I hope to see you again at one of our future sessions. Thank you very much.